It's Tuesday, February 17th, 2026. And the Dow, well, it just crossed the 50,000 mark.
Which should feel like a huge celebration, right?
Right. But it really doesn't. If you look at the actual market today, nobody's breaking out the champagne.
No, not at all. It feels, I don't know, tense. The VIX, our so-called fear gauge, is up over 6% just this morning.
There's a huge disconnect there, and that's exactly why we're doing this deep dive. We've been digging through a stack of reports from BlackRock, iShares, XTB.
And NASDAQ market data, too.
Yeah, to figure out why 2026 feels less like a party and more like a waiting game. And it seems like all of this anxiety points back to one single day on the calendar.
May 15th, 2026.
Okay, so why that specific Friday? What's going on?
That is the day Federal Reserve Chairman Jerome Powell's term officially expires.
Ah, so it's a leadership change.
Exactly. And in the financial world, that creates, what they call a lame duck session. The consensus in the iShares report is that the Fed is effectively frozen until that seat is filled.
Frozen, meaning no big moves on interest rates.
Very unlikely. They're not going to make any kind of drastic change with a leadership vacuum right around the corner.
Haven't they already been cutting rates? Since late 2024, they've dropped them by, 175 basis points, or sitting around 3.5%.
We are. But the target, the sort of neutral rate everyone wants to see, is closer to 3%.
Okay.
We still have that last mile to go. The problem is, with Powell heading for the exit, that last mile gets delayed.
And the economy might not be able to afford that delay. That seems to be where things get tricky.
That's it, exactly. We were looking at the XTB data on retail sales, and December was, well, it was flat, 0% growth.
Wow, 0.
And it's even worse if you pull out volatile things like autos and gas. It just stalled completely. That's a huge red flag for consumer fatigue.
So the average person is getting tired of spending, which would normally be a signal for the Fed to step in, cut rates, and, give the economy a boost.
But if they're paralyzed by this transition,
Then there's no safety net coming.
pretty much. And that's what's making investors so nervous. You see it in that AI fear trade that's dragging down the NASDAQ today.
Yeah, Nvidia and Amazon are both in the red.
It's a big reassessment. We've poured billions into AI infrastructure, and now investors are starting to ask, okay, where are the profits? If borrowing costs stay high because the Fed is on the sidelines, those expensive projects suddenly look a lot riskier.
So if you're a listener trying to figure this out, you have a paralyzed Fed, a tired consumer, and shaky tech stocks. Where are you supposed to put your money?
Well, iShares has a very specific strategy for this exact kind of limbo period. They call it playing the belly of the curve.
I hear that term a lot. Let's break that down for us. We're not talking about short-term cash or 30-year bonds.
Right. The belly is the middle ground, usually the 3 to 7 year Treasury bonds. Think of it as the Goldilocks zone.
Okay.
You're not taking on the massive risk of a 20-year bond, but you're locking in a decent yield for longer than a few months. It's a defensive play to ride out the uncertainty.
But the BlackRock report took it a step further. They're suggesting we might need to look outside the U.S. entirely.
Yeah, and this was maybe the most surprising nugget in the whole stack. We get so U.S.-centric, we can miss that 2025 was a boom year in other places. South Korea was up over 70%.
70%. That's massive outperformance.
It is. Spain was up nearly 50%. It just highlights this key risk of home bias. While we're all stressing about the Fed chairman's expiration date, other economies are accelerating.
So diversification isn't just a buzzword right now.
No, it's a necessary hedge against our own policy paralysis.
So to boil it all down for everyone listening, 2026 is shaping up to be this collision between a cooling economy that really needs some support and a central bank that effectively can't provide it until this summer.
That is the dynamic. It's a game of chicken between the economic data and the political calendar.
All right, and here's the final thought we'll leave you with. This comes from BlackRock. AI capital expenditure, the money companies spent on chips and data centers, hit $395 billion in 2025.
A truly historic amount of cash.
So if those massive investments don't start paying off right away, and the Fed is late to cut rates because of this May 15th transition, are we just looking at a simple market correction? Or are we staring at a massive policy error that could pop the entire bubble?
That's the question that should keep you up at night.
Thanks for listening to The Deep Dive. We'll be watching the charts.